We are covering the student loan interest deduction, a key above-the-line adjustment that every tax preparer must know for the exam. This deduction allows taxpayers to reduce their taxable income by up to $2,500 for interest paid on qualified student loans. Because it's an above-the-line deduction, it's available even to taxpayers who do not itemize and take the standard deduction. The maximum deduction is the lesser of the actual interest paid during the year, or $2,500. The exam loves to test the limitations and qualifications, especially the Modified Adjusted Gross Income, or MAGI, phase-outs. For 2025, the deduction for single filers begins to phase out at a MAGI of $85,000 and is completely gone at $100,000. For those married filing jointly, the range is $170,000 to $200,000. Let's walk through a typical exam problem. Suppose a single taxpayer, Maria, has a MAGI of $90,000 for 2025 and paid $3,000 in student loan interest. First, her potential deduction is capped at $2,500. Next, we must calculate the phase-out. Her MAGI is $5,000 into the $15,000 phase-out range. We divide $5,000 by $15,000 to find that 1/3 of her deduction is disallowed. 1/3 of $2,500 is $833. So Maria's final allowable deduction is $2,500 minus the $833, which equals $1,667. Be prepared to do this exact calculation on the exam. Another major trap involves who is eligible to take the deduction. The exam might present a scenario where a parent pays a student loan for their child who is no longer a dependent. The rule is that the person who is legally obligated to repay the loan is the one who can take the deduction. In this case, even though the parent made the payment, the child is treated as receiving a gift from the parent and then paying the interest themselves. Therefore, only the child, who is legally responsible for the debt, can claim the deduction, assuming they meet all other requirements. You cannot claim this deduction if you are married filing separately or if you can be claimed as a dependent on someone else's return. To remember the key points, use the mnemonic MAD 2500. M stands for the MAGI phase-outs, the most tested part of this rule. A reminds you it is an above-the-line deduction. D stands for dependent, as the loan must have been for the taxpayer, their spouse, or a dependent at the time the loan was taken out. Finally, 2,500 represents the maximum deduction amount. The loan must be a qualified education loan, meaning it was used solely for qualified education expenses like tuition, fees, and room and board at an eligible educational institution. The taxpayer should receive a Form 1098-E if they paid $600 or more in interest. But they can still deduct qualified interest, even if they don't receive the form, provided they can prove the amount paid.